Money. We use it every single day, right? We earn it, spend it, try to save a little. It's just there. But have you ever really truly stopped to think about what it is or where it even comes from? It's this giant system that we're all a part of, but most of us don't know the first thing about how it works. So today, we're going to pull back the curtain and see what's really going on.
And that's the big question, isn't it? That piece of paper in your wallet, or just the numbers you see on your banking app, where did they come from? How did they just pop into existence? And who's in charge of saying what a dollar is actually worth? Well, the answers reveal this incredible hidden machine that runs our whole economy. And trust me, it's way more fascinating than you think.
So, to get to the bottom of that, we have to start with the absolute basics. Let's ask an even simpler question. What even is money? Let's build this from the ground up.
Way back when, money used to be things like gold or silver, stuff that had its own value. But today, pretty much the whole world runs on what's called fiat money. And that dollar bill in your pocket has value for one reason and one reason only. The government says it does. That's it. It's basically a promise, a powerful shared belief that we all just agree to.
So why do we need it? Well, money has a superpower. It makes our lives so much easier. I mean, can you imagine trying to barter for everything? You're a graphic designer and you need a loaf of bread. You'd have to find a baker who just happens to need a new logo right now. It would be a nightmare. Money solves all of that. It's the one thing everyone accepts, which makes trade super simple.
Okay, so money is a tool and it's built on trust. Got it. But where is it actually born? Let's trace the dollar back to its actual source.
And the whole journey starts right here, with what economists call the monetary base. You can think of this as the seed money, or high-powered money. This is the foundation created only by the central bank. And it's from this initial pile of money that all the other money in the economy is going to grow.
But, and this is the really mind-blowing part, the central bank doesn't create most of the money that you and I actually use every day. Commercial banks, like the one on your corner, do. And it all happens through this amazing process that works just like a ripple spreading out in a pond.
Okay, check this out. This is the magic of what's called fractional reserve banking. So the central bank starts things off by putting $100 into Bank A. Now, Bank A can't just lend out all of it. They have to keep a fraction, let's say 10%, in their vault, but they loan out the other $90. Now that $90 gets spent and eventually deposited into another bank, Bank B. And what does Bank B do? The exact same thing. It keeps $9 and loans out the other $81. With every single new loan, new money is literally being created.
So, after all of those ripples of lending and depositing keep going and going, what's the end result? That initial $100 injection from the central bank can grow into $1,000 in the total money supply. Get this, $1,000. That's the money multiplier effect, and it's how most of the money in our economy is actually born.
All right, so now we know how the money supply can basically expand out of nowhere. But so what? What does all this extra money floating around actually do in the real world? Well, it has a huge, direct impact on the price of everything you buy. You know, before we even get into any fancy equations, the basic idea here is just super simple common sense. If you suddenly have way more money in the economy, but the amount of stuff to buy, cars, houses, coffee, stays exactly the same, what has to happen? Prices have to go up. It's just more money chasing the same amount of goods.
And of course, economists have a neat little formula to capture this very idea. It's called the equation of exchange. It might look a little intimidating, but it's really just a formal way of saying what we just did. More money chasing the same stuff.
So let's break it down really quick. M, that's the money supply, all the money out there. V is velocity. Just think of it as how fast money is changing hands. How many times does $1 get spent in a year? On the other side, you've got P, the overall price level, and Y, which is all the real stuff our economy actually produces, like our GDP. Both sides of this equation have to stay balanced.
And this is where it all clicks. If you double the money supply, M, but the economy is still producing the same amount of stuff, Y, and people are spending at the same speed, V, well then to keep everything balanced, prices, P, also have to double. This, right here, is the basic engine behind inflation.
Okay, so if the amount of money has such a powerful effect on inflation, it becomes pretty obvious that controlling the money supply is one of the most important jobs in the entire world. So how do they actually do it? What's in the policymakers' toolkit?
Turns out they have three main levers they can pull. First, there's open market operations. That's just a fancy way of saying they buy government bonds to pump money into the system or sell bonds to pull money out. Second, they can change that reserve requirement, that 10% we talked about, to make the money multiplier stronger or weaker. And third, they can change the discount rate, which makes it cheaper or more expensive for banks themselves to borrow money.
But here's the thing. Having the tools is one thing. Using them is a completely different story. It's not simple at all. In fact, it's like walking a tightrope every single day, an incredible balancing act with huge consequences for all of us.
And that's because of a really key economic idea called money neutrality. The theory is that in the long run, just printing more money can't actually make a country any richer. Sure, it can change prices, it can change wages, the nominal stuff, but it can't magically create more jobs, build more factories, or invent new technologies. The real economy is kind of separate from the amount of money floating around.
And this leads to a classic and really tough dilemma. In the short run, there's this tempting trade-off. It seems like policymakers can get unemployment to go down a little bit if they're willing to let inflation go up. But here's the catch. In the long run, that trade-off completely vanishes. People's expectations catch up, and unemployment just goes back to its normal level, except now everyone is stuck with higher prices.
And that, right there, is the ultimate challenge. Central bankers are in a constant battle trying to manage the economy's short-term needs, like fighting off a recession, without messing up long-term stability by creating crazy inflation. It is, no joke, one of the most difficult jobs on the planet. So there you have it. From its birth in a central bank, to its multiplication through commercial banks, to its effect on prices, and the incredibly difficult job of keeping it all under control, that is the life of a dollar. But, as we move into this new world of digital currencies and crypto, it leaves us with one last really big question. Can this whole system even last?